We'll call the meeting to order. Roll call. What is today? Today is August 25th, 2021. Consolidated Board of Trustees. A roll call. President myself, Eugene Dugan, Trustee Chair.
Bruce Giles, Trustee.
Harvey Laws, Trustee.
William Johnston, Staff.
Gregory Williams, Staff.
And Mr. Chairman, if I could just mention, Walter Berry had indicated he would not be here in person, but that he might try to he might try to Zoom into the meeting. So if the board would approve his attendance through Zoom, just in case he does do that, and he may be in the waiting room right now. There he is. Okay, so according to state statute, we need to, the board needs to approve Walt Berry's attendance through Zoom for him to be able to vote on items.
Voting power.
So if the board would do that now, we could allow Walt to join.
My motion.
So there's a motion to approve Walter Berry's attendance through the internet for voting power. Is there a second?
I'll second that.
All right. All in favor, say aye.
Aye.
Any opposed? The motion passes. All right.
Bruce, you may need to mute your laptop. I don't know if are you on in the meeting through that?
No.
Okay, you may just be right under a speaker or something.
All right, we have an agenda before us. Is there a motion to adopt the agenda?
Now I'll make a motion to adopt the agenda.
All right, second. All in favor, say aye.
Aye.
Any opposed? All right. We have the regular meeting minutes from July 21st, 2021. Is there a motion to waive the reading of the minutes, or does someone want to hear them?
I say we waive them in.
The reading of the minutes?
Yes.
Second. All right, all in favor?
Aye.
Any opposed? All right, we're up to Mr. Bob Klausner, Board Attorney update.
Good morning.
Good morning.
Hope everyone is doing well. Indeed. It's actually quiet. State has approved your reports. The money should either have gotten to you or be in transit. And considering I don't want to push my luck after that, that's the end of my report.
Checks in the mail. Awesome. I really thought he was joking.
We actually, I included an update as an informational item further into the agenda, but just so everyone's aware, we did receive the money on, I believe it was last Thursday, and so the amounts are listed here. You can see what the premium tax collected actually was, and then the 8% service charge that the Division of Retirement takes. The city didn't owe them anything. I'm not sure. I don't think we've ever, I don't know what that is exactly. They also charge a small database expense fee, and these are the net proceeds that the city received for police and fire.
And into the police, y'all keep 535? Is that correct?
In that ballpark, I can bring a spreadsheet next time that shows the base amount and all the history of the returns, but that's it's in that ballpark, yes.
And can you, for the next meeting, bring the, those eligible for that,
Sure.
that
share plan?
disbursement? Yeah.
Yep, we can bring that eligibility list next time.
And are we assuming that just within 90 days, those to receive the, again, I already have Scabola asking when he get his.
I thought I was the only person he sent text about.
Oh, no, I got Jay Rowe calling me too.
You know, the funds go into the share plan, and people who are still active, you know, we calculate it as part of their balance, but they don't actually receive it until they retire.
These are the two that have actually retired.
Okay, they should get it within whatever the time frame is.
The 90 days.
Yeah.
And this is just 2020, correct?
Right.
This
Right.
number here. This
Eligibility
number.
is already.
We've already received the one that was in
The
abeyance, or they were holding on to, or
The
whatever.
18 and 19 we received in January of this year, and it's
January.
for the most part been distributed. there might be a few guys at ICMA that haven't gotten theirs yet, but I think risk management is working on that.
All right. Good deal. Thank you for all the work.
I can give you a list of those that are looking for that second check, but that's up to you.
Some have contacted us, and, you know, I think risk management is working with payroll to make sure that we get that into their accounts. I think payroll needs the ICMA account numbers before they can send the money to ICMA. And so they have to get that information from risk management.
If they elect to just take a check for that, I know there was some.
If they're active, they can't do that.
No.
They're gonna get the same choice they got with the last distribution, take it as cash, roll it into a tax deferred option, so.
Yeah, what happened was that they had already separated, and then that money was already, so there are two that they had already separated. They got their check for their 185 money for the first check.
Right.
And, but they got a check. And although they had already actually had it assigned into their own account, previously, they had already signed up for that. So every year that money was, supposed to go into those accounts. So when they got their disbursement, they got a check. Well, one decided to spend the money. Well, unfortunately on this side, there was just a mistake. And what happened was he got the check. Unfortunately, he's also spent the money. And it was actually already put into his ICMA. So either he never got the form or, and again, it was the first time us doing it. So I get it. Under this.
So now he owes it back.
He owes it back.
Yeah.
But then you take the 20% off of the taxes that he took to pay, that he got when he received the check, then he had to go back into his ICMA and then take that hit. So I'm asking mainly even for myself, so because I'll separate February 1st, and then I'll be looking for that. I'll be that guy, October, November, hey, where's that other check? But I want the check. I don't want it to go into ICMA.
Right. So, I mean, my understanding of the process is that, risk management communicates with the retirees and, sends them a form asking how they want that distribution. And when they get it back, they send it over to the payroll area and payroll processes it. But, if any members want to speak directly to payroll about it, they can call in to see what's going on with it. It doesn't hurt to do that, or to risk management, I think.
Okay. It just mainly,
If there's no response after 60 days,
then they
it's distributed.
Right.
So,
When do you separate? February?
Yeah.
it usually takes about 30 days. from
Bob, you still there?
years to-
I'm here.
What did we, I know we discussed this before. What was the determination on retirees on the board? Is it to finish their
You can finish your term.
term? Okay.
You're allowed to continue in office until the expiration of your term. You just can't run again because you're no longer, quote, active.
Yeah. Okay. Perfect. When does our term? We're right on the same.
Who's quitting?
Lieutenant Giles. He's retiring, right?
Yeah, I'll be retiring.
He has an
Don't
expiration.
you know once you're on the board, you give up the right to retire?
Oh, well, I would love to stay in the drop, but Steve over here says no.
It's a life sentence.
Well, actually, the members who bargain the back really.
You're right.
All right. And we're on the same timelines, I think, for terms.
Yeah, I think it's like May or June.
Okay. Y'all live right, so I have it on my work book. Bob, are you gonna be staying on with us? Do we have any questions for Bob further in the agenda here, William?
I don't think we do. Bob, one quick question. Have you had any progress with Pretium or the other investment managers?
Yes, we sent some additional language, and we might have broken the logjam on that. Basically, it has to do with their willingness to accept that we're granted certain statutory rights that I don't care what we say, we can't give them up. The legislature has mandated certain things occur, and the law says if you take the money, you follow the rules. It's the golden rule, because the one with the gold makes the rules. If they don't take this latest round, I'd tell you I wouldn't give them any money.
What is this?
Because we'll end up in a fight with them later, and it will be unfortunate.
And so we can just get another update in September, at the September
Yeah,
meeting.
I'll be able to update it before. We just had an exchange of emails yesterday. So William, I'll keep you posted and we'll either have a yay or a nay by then.
All right.
The problem is when you're looking to put $10 million in something and it's got $1 million in it, it's hard to move the needle on their end because it's a business decision. Just like it's a business decision for us if a manager or a fund of funds isn't willing to observe a certain set of behaviors for the protection of Gainesville. Good investment or not, the risk outweighs the reward in my opinion.
All right.
Thank you, Bob.
Thank you, Bob.
Okay, anything else you need from me?
I don't think so.
All right, everybody stay healthy and take the shot. It isn't going to kill you. I took the third one yesterday, and other than a sore arm, I'm still here. I'm still upright. So,
Well, I'm gonna take my third when I get back to the beach.
better safe than sorry. We've lost too many. On a serious note, actually, we're moving death benefit applications with the federal government, the public safety officer death benefits. We're doing 14 of them right now.
Wow.
And most of those that passed, in fact, I think all of those that passed were not vaccinated, which means had they been, they'd all still be here. And that's a tragedy. So, all of the police and fire service for almost 45 years, we've lost too many brothers and sisters. I don't want to lose another one. So, they might have, the vaccine might have some side effects, and yes, there are going to be breakthrough infections, but, you take the flu shot, you might get the flu, but you don't die. And that's what I worry about. So, and many of these that passed were 25, 30 years younger than me, so we don't need that.
Bob,
But hey, on that cheery note, you should take pride in the fact that you are 101% funded. That's extraordinary. Puts you high to keep in the country. I tell everybody says, what's Gainesville's secret? I said, brilliant administration from the Board of Trustees.
Here, here.
All right, I'll see you all next month.
Bob, don't go yet.
Go ahead.
Bob.
What, did you have something before I go?
Yes, Bob, it's Steve Arvell. With the September update, do you mind kind of sketching out, either in a memo to us, the deficiencies in the contract language so we have that as part of our, the information to, because I'll tell you right now, I'm certainly not one that will say, ignore advice of counsel, but I'd sure like to be able to see it and
Oh yeah, I have saved the whole stream of
all right, thanks, Bob.
exchanges. I'll send it, I'll put it together. I'll leave the BS out and I'll isolate the issues into a separate memo, send it to William for distribution.
Thank you, Bob. Appreciate it.
Okay,
All right.
good to see everybody.
Good to see you.
Bye-bye.
Next on the agenda, presentation from Mr. Steve Scatrid of Sustainable Growth Advisors. Are you there, Steve?
Yes, I am.
Sorry if I pronounced your name wrong. Hello.
Hello. Well, thank you very much for the invitation here to speak with you today. And hopefully you've got the materials that I had sent on over. What I'd like to do is just tell you a little bit about our firm, since this is the first opportunity we've had to speak with you, and then talk a little bit about the investment approach and what's been going on in the markets and how your portfolio has been invested. And please jump in with any questions that you've got as I'm going along, okay? Our firm, Sustainable Growth Advisors, is located in Stamford, Connecticut. We're a relatively small firm. We have 32 employees, 17 of which are equity owners in the firm. We manage about $24.6 billion And that's using the same exact investment approach across our U.S., our global, our international, and our emerging markets portfolios. And I'll talk about what that is. We've had no change in our investment personnel over the last year. In fact, we've only lost one research analyst since the inception of the firm. So we've been extraordinarily stable. And a lot of that has to do just with the culture of the firm, with the equity ownership culture that's been built here. When we have employees join the firm, it's a very long, drawn-out process, and we make sure that there's a good fit. We did add to our client service and our compliance staff this year as we've continued to grow. We want to make sure that we're covering all those needs well. And you can see just the summary of some of that information on slide 2 of the materials. You can see the investment team on slide 3. The portfolio managers for this portfolio are Rob Rohn, who's one of our founders on the bottom right there on slide 3. Also on Gordon Marchand in the center there, on the center bar on the right-hand side. And then Kishore Rao over in the bottom left. We have 3 portfolio managers on a portfolio. 2 of the 3 need to agree in order for any purchase or sale or trim or add to take place in the portfolio. Each of the portfolio managers is also a research analyst. If you look at the folks here on slide 3, each of these people is a research analyst. And one unique factor I think that is a benefit to our clients is we've got 2 analysts covering each and every stock that is on our qualified company list, which is essentially our buy list. We think that is important just in terms of being able to make sure we've got the broad perspective and the objectivity on those companies. So you have a primary and a secondary analyst covering each company that we follow and that we invest in. What we're trying to do is find unique long-term secular growers. We're looking for companies that have some type of unique attribute that it makes their growth a little bit more sustainable and predictable over time. It's certainly higher growth. We're looking for in companies over a longer time period. We use a 3 to 5 year time horizon, and we do that so that we can take advantage of shorter term inefficiencies in the market. If you look, you'll see that many of the many of the companies that are in the portfolio have been there for 3, 5, 7 years. The turnover in the portfolio is about 35% per year. It's very episodic though in terms of if there's higher volatility in the markets, our turnover tends to go up as we take advantage of that volatility. Likewise, in the lower volatility market, the turnover tends to come down, but it averages about 35%. We're building these portfolios based purely on opportunity, whether or not a stock is a member of the index is immaterial to us. What we're looking for are the 30 most opportune investments that are likely to give you the best returns over that 3 to 5 year time period. We also think that valuation plays a critical role in growth investing. We look at valuation based on cash flow metrics. We use a proprietary measure which we call the cash flow available to shareholders, which is a much more conservative form of free cash flow. And we think that it's really important to make sure you get that entry point right as you're initiating an investment in a growth company, but likewise that you're very careful in terms of not riding that growth over the cliff, if you will. I want to make sure that as valuations get stretched, that you're redeploying that cash towards other growth opportunities, looking out over the coming 3 to 5 years. We limit the number of stocks in the portfolio to 30. We're not going to own a 31st or a 32nd. What that does is force us, every time we want to buy a stock in the portfolio, we have to evaluate and understand where that money is going to come from, which stock are we going to sell in the portfolio. And that, again, is a real good discipline in terms of making sure that you're always looking at whether or not, which stocks are getting a little bit more expensive, where's the thesis at the margin starting to weaken, any of those types of points. And that's been the approach that we followed since day one. If you look at slide 5, I think this, just from a pictorial standpoint, explains it well. What we're trying to do is really combine business quality factors and growth factors, first of all, in terms of identifying companies that are going to fit within this portfolio. And you can see here the quality parameters. Quality is a big factor, a big word, and a lot of people look at it differently. The way we think about it is we want companies that have strong pricing power relative to their peers. If they've got that strong pricing power, particularly if you look over the last couple of decades here where inflation has been very, very low, they've got something quite unique relative to their peers. And this is important also as you look at inflation going up. If you've got companies that have pricing power, have the ability to pass those increased input costs on, that puts them in a much better position to be able to maintain their profitability and grow that profitability. We're looking for companies that have recurring revenue streams so that they're less susceptible, less sensitive to changes in the macroeconomic market. And that's really important if you look at just the period that we've been through here over the last year and a half now with COVID. As you look at companies that are not really going to be as sensitive to fluctuations in economic growth. And then we're looking for those global opportunities, the ability of these companies to sell their products or their services more broadly, either globally or from a geographic standpoint, or within a market, or if they've got new products, new services that they're bringing out that are unique, that extends out the duration of their growth. The financial strength, obviously we want strong balance sheets, but here again, the free cash flow generation is critical to us. If you've got strong free cash flow generation, you've got something very unique relative to your peers. And then management strength, we're looking for management teams that have shown the ability to execute the business plan as we see it, and also that they've been good stewards of shareholder capital. We marry that with the growth outlook. We're looking for companies that are going to grow typically around 2 times that of the market in terms of earnings and their revenues. And once we've got those factors, once those factors are satisfied, then valuation comes into play. Only at that point does valuation come into play. Once we're differentiating companies versus each other to determine which ones we want to put into the portfolio. Let me just stop real quick there and see if there's any questions from a process standpoint or from a firm standpoint. Then I'll get into the performance and the portfolio itself. Anything you'd like me to answer there?
I don't believe so.
Okay, great. What this process does is, lead to more downside protection. It protects capital in those weaker environments, in those more difficult environments, and you can see that on slide 6, where you've got downside protection that it's about 63%. capture about 63. Downside was we capture about 86% of the upside. So what that does is give you a much smoother ride, get these variations in the market. And if you look at slide 7, this just gives you how this compares over time. We've been able to generate strong risk-adjusted returns over the life of the portfolio. Taking a look at the portfolio itself, you can see your portfolio as of the end of the second quarter was up about 11%. That was relative to about 11.9% for the index, up about 17% year to date versus about 16% for the index. Through August 23rd, your portfolio is up about 20.5% year to date versus about 19.2% for the index. And you can see the figures for the composite. What we've had over the last few quarters here is really a strong cyclical rebound off the lows that were generated by the COVID pandemic. You've had stocks that were hurt the most in that weakness, popping, jumping up, rebounding very strongly. And a lot of those companies tend to be a little bit, lower in terms of their business quality, more economically sensitive companies. They tend to be smaller cap and value-oriented companies. That's what's driven the market over the past couple of quarters. If you look at Q2, though, on the second quarter, the rebound continued, but the complexion of the rebound changed during that time. And as you started to have more concern about the Delta variant here and the spread of it, the impact it was having on reopenings and economic growth, not just here in the United States, but globally, you started to see those more economically sensitive companies giving back some of their gains, and growth started to regain some of its leadership, and business quality parameters, which had not been frankly rewarded over the last few quarters, started to see more reward as people pulled in their risk a little bit and wanted to be a little bit more sensitive to what was going on in the macroeconomic environment. We think that that's likely to continue, and unfortunately, with all these variants, with the issues that we've got in terms of the reinfections, in terms of whether or not the vaccines are going to be sufficient for some of these variants, it's very likely that the economic rebound that you see and the improvement in corporate profits is going to be very volatile. We think that it's not going to be quite as rosy maybe as what the market's been anticipating. And there's been a lot of good news that has been discounted into stock prices with the very large rebound that you've seen over the last several quarters. So we do think that volatility is likely to increase here, particularly as you go into 2022, and you've got the fiscal cliff, which I'm sure you've all read about, with $1.8 trillion of stimulus not being replaced. You've got higher tax rates likely on the corporate and the personal side. You've got higher regulatory costs. You've got the China going on, which impacts all markets. So you've got a lot of different things, inflationary concerns that are likely to contribute to that volatility. So we think that more predictable, sustainable growth is frankly the place to be in a market like this, and should be well positioned. If you take a look at slide 13, this shows the key contributors and detractors to the portfolio over the last quarter and over the last year. and I'll talk about a few of these, and if you have questions on any of the companies listed here, please just let me know. And the key contributors over on the left-hand side were Intuit, Alphabet, and MSCI, and they were the top three. Intuit is a company that you're probably familiar with them through their TurboTax and their QuickBooks and their Credit Karma products. It's a software company that creates specialized software for accounting firms, and they're a leader within this market. They actually had a real solid report. They're getting good cross-selling between the sales process for these different products, so we're real pleased with that. Alphabet, real strong search results, also cloud results. Here, we like the story longer term, but we are very cognizant of the valuation getting up there a bit. Also, some regulatory concerns in the EU, as well as the US here from antitrust standpoint, from a data standpoint. So we did trim back on that one on the strength. And then MSCI, which was a recent addition to the portfolio, they have a lot of participation within the specialized index area, as well as within the ESG market, which is burgeoning at this point, not just in the United States, but certainly even more so in Europe and Australia. And they are a firm that turned in some real strong results as well. On the negative side, Walt Disney was the largest detractor here. They've had some real strong numbers in terms of their streaming growth. If you look at their Disney Plus offering, the continued growth there in the streaming was good, but it wasn't quite as good as some of the optimistic expectations that were in the market. Some of that has to do with some of the production delays that have occurred over the last several months due to COVID restrictions. We think that that's a temporary type of thing. Actually, their free cash flow generation, their margins were actually very, very strong. That's something we look at very importantly. And theme park business is coming back very, very nicely as well. They actually, we think they're coming back in a much smarter way in terms of, they've learned from the pandemic experience here, and they are doing some things very well. So we added to that stock on the weakness. We think that there's a real good 3 to 5 year growth story here as the pandemic recedes eventually here, and as you start to see that streaming content come through again. Workday was the second largest detractor. Workday is a human capital management software as a service provider. They create software for HR departments, and they also are now creating a specialized software in the financial and the planning areas as well. The HR side of the business is doing quite well. They haven't been able to do quite as much of the cross-selling, frankly, on the financials and the planning side due to just many businesses being closed because of COVID, staff's not being in, that sort of thing. It makes that cross-sell experience a little bit more difficult, and we see that changing. So again, we added to that position on the weakness. And FleetCor is the third largest detractor here. The company makes up closed-end payment networks, and what that means is they put together groups of companies that will service fleets of trucks and car fleets and people who travel quite a bit. They offer fuel cards. They offer maintenance opportunities for these big 8-wheelers as they're being used. They can, companies can track what's happening on the fuel side, on the maintenance side, on the lodging side, that sort of thing. And what the company does actually is buy these services in wholesale, essentially getting them cheaper, and then they can pass some of that savings on to the companies. So the companies get these things at a cheaper price, but they also get the specialized reporting so they can follow up on what their drivers are doing, how they're following the different procedures, those types of things. So that company turned in strong results. The one thing that was weaker within their business is they have a tolling business down in Brazil. The tolling side of the business was weaker, just given the COVID experience down in Brazil, which has been very, very difficult. So those were the key contributors and detractors here in the last quarter. Again, I'm happy to talk about any of the stocks listed here. We've also provided some summaries on each of the key detractors here on the next few pages for you, just to give you a little bit more background on those companies. Can I answer any questions on any of those companies or any of the stocks listed there in the portfolio?
Yeah, Steve, Eugene Dugan here. I got one question. I think you already said it. How often do y'all swap out the companies of the 30? Is it just as needed, or do you all have there's a set quarterly to change so much?
Yeah, no, what we do is we've got price targets, certainly, for companies. What they are, again, we're looking at 3 to 5 years in terms of, the modeling that we do for the businesses. And so we've got, the price targets that our analysts set. Then we also run discounted cash flow models, where we get a ranking of the valuations for the businesses. And we also run an enterprise yield calculation, which is a shorter term valuation metric, and we look at all three of those valuation metrics for each company every day that's in the portfolio, because as I mentioned, in order to buy a stock, we're going to have to sell a stock, so we're constantly keeping track of where valuations are starting to get a little bit less attractive, where they've gotten extended, and what you'll see us tend to do is average out of that stock over time and redeploying that cash towards other places within the portfolio where we see similar or better growth with more attractive valuations. We'll also, if we see a stock getting to the point where valuations are just too high, we'll sell that stock out and we'll bring in a new position. And what you'll tend to find is that we average into those new positions as well, building them opportunistically as the market is varying. The turnover in the portfolio over time has been about 35%. So about 35% of the portfolio is turning over. About half of that is full new positions, and then about half of that is the trimming and the adding that goes on with the different names. Does that answer your question?
Yes, sir. Thank you.
Sure.
Steve, you bought more ring when it's one of your loans. Is it the same reason you bought ring as why you bought this?
I'm sorry, could you repeat that question? I didn't hear all of that, I'm sorry.
Did you buy ring for the same reason you bought more Disney, for price?
Yeah, Ring Central is the stock that we purchased in the portfolio this quarter. Ring is a company. It's a software as a service communications platform, and what they're really good at is you've got the traditional enterprise side of the business, which is pretty much the standard vanilla communications side with phones and that sort of thing. But what they do also is they're got some very unique and very good modules which work for team messaging, which is frankly really helpful in these remote situations, also for team conferencing. And so we like the technology that they bring to the table in terms of sort of the alternative work approach. Instead of everybody being in an office, being able to tie people in and communicate on a timely basis, through their software. It's a segment of the market where there's a lot of, frankly, more traditional players that don't have the technology, don't have the software that these guys do. So we think that they're going to be able to draw a lot of market share relative to other players that aren't positioned as well for this more remote work type of environment going forward. We think that the market is big enough to be able to handle 2 to 3 more dominant players, and we see them as being one of those dominant players.
How new is Ring Central since their 52-week high is $449, but we're down to $270 now? I mean, I like we bought low, but it keeps dropping. I'm just wondering what's bringing it back up?
Yeah. What knocked that down is, frankly, it's not one of the more cyclical names that had been rewarded over the past few quarters here, and even into the second quarter. We think that as people see the predictability, their ability to gain market share, it's kind of a wait and see type of thing. We need to show that they can gain market share relative to these traditional players. We think that it'll become more visible at that point. So to your question, it was I would say not in the sweet spot of the market earlier on in the quarter, and you're looking at a situation where you need to be able to see some visibility in terms of their market share gains. We've actually continued to add to the position on some of those weaknesses. As I mentioned, we tend to average into positions. We'll take an initial position, then we'll add to it as we go on. What you'll tend to find is we are typically, because we want to find these businesses at pretty attractive valuations, we're going to be into a stock a little bit earlier than you may find with more traditional growth managers. We're trying to really buy those long secular growth at attractive valuations, and then build those positions as we get the opportunity in the markets. So it's really a visibility thing at this point for them to be able to show what they can do.
Thank you.
Yep. You've got a write-up, the company there on slide 20. You've got the portfolio itself here on slide 21. Just a couple things I'd point out on slide 22. This gets to the valuation focus that we've got in the portfolio. If you take a look at the chart there on the right side of slide 22, you'll see we're about 10% underweight the technology segment, about 6% underweight the consumer discretionary segment. These are the segments of the growth market that have done extraordinarily well over the last couple of years, and where you've seen valuations get much more stretched. And we've been moving out of those companies, selling those companies, redeploying the proceeds towards other areas in the portfolio. You'll see we're about 12% overweight in the healthcare segment, 3.9% overweight in the financials. That's very typical of what you'll see with our approach. Again, you're taking capital from areas that have gotten more expensive and redeploying it towards high growth areas that are less expensive. Again, taking that 3 to 5 year outlook, looking for those companies which we think can grow more quickly over those 3 to 5 year periods. Ring Central being a good example of that. and you haven't seen the visibility quite yet, and we think that they are in a position, given their technology, to be able to compete more effectively and take market share relative to their peers. Then you can see on the upper left-hand corner there, just allocation across the growth buckets. And you've got the companies that can grow about over 20%. That's about 46% of the portfolio currently. Then you've got the 15 to 20% bucket and the 10 to 15% bucket. These are all 3-year earnings per share growth rates for the companies. So you can see how and that's going to vary significantly over time. At periods where you've got a lot of optimism in the market, where you've got valuations going quite extreme, and there's not a whole lot of volatility, you're going to see us taking weight out of those higher growth companies and redeploying it towards maybe some of the 5 to 10% growers. The 10 to 15% valuations are more attractive. Likewise, in periods where you've got more difficulty, and you can access some of those real high growth companies at attractive valuations, you'll see the weighting in those companies come up. So it's going to vary over time, but the portfolio is opportunistic in terms of trying to position it like that. Over time, what you should see with the portfolio is significantly better earnings growth relative to the market, better revenue growth, with higher quality in terms of higher cash flow generation, better margins, less variability in terms of the growth. And you can see that on slide 23. Over the next 3 years, the portfolio should generate about 25% earnings growth versus about 16% for the market. And frankly, we think the 16% is actually quite optimistic at this point, just given there's a lot of optimism that's been built into estimates before Delta started creeping in here. And on the revenue side, should generate about 13% revenue growth relative to about 9%. For the index. So that's kind of a summary of where the portfolio stands. At this point, I'm happy to answer any other questions that you've got on the firm, the portfolio, the approach, whatever would be helpful.
Staff have any further questions?
I don't have any. Cole, did you have any questions?
No, not for me.
Not hearing any questions, Steve. Appreciate the presentation. Did you have anything else for us?
No, I think at this point, just thank you very, very much for the opportunity to speak with you today, and thank you very much for the relationship that we've got here. And if there's ever anything that we can do to answer questions, I'm right here. Just please feel free to let me know.
All right. Thank you, Steve. Appreciate it.
All right.
Stay healthy.
You guys take good care. Bye.
All right. Next on the agenda is a presentation from Willis Towers Watson. I know we have Cole. Is Zachary with you also, Cole? Or is it just you?
Yes.
All right. How y'all doing?
Good. How are you guys?
We're here. We're live.
Well, that's what I like to hear. We'll jump right in to the executive summary document. No action items for us today. We'll give an overview of capital markets year to date, and then planned performance, and we will conclude. So, William, if you want to skip over to slide 4, we can review the capital markets, and this is for the through the end of June, and then I'll give a quick update through the end of last week. So, in the top left chart here, you can see the S&P 500 year-to-date returned over 15% thus far. 8.5% of that was from the second quarter. So we continue to see strong performance in the U.S. equity markets. Small cap stocks doing a little bit better, up 17.5% year to date. And then the bottom two, looking at the developed and emerging market, the global stocks there. Positive performance at around 8% for both of those year to date, but not keeping pace with the strong performance of the U.S. markets. Over on the right, you can see performance is a little bit more mixed in the fixed income markets. So the Bloomberg Barclays Ag, that top one there, positive quarter, but still negative year to date, minus 1.6. Similar with the longer dated bonds there, the long government, long credit, both had a good quarter, but are still negative performing year to date. The type of bonds that you primarily holders for that bottom category, U.S. high yield corporate, which has performed well both for the quarter and year to date, up 3.6%. You can see the treasury rates on the bottom right. As you know, rates have increased pretty substantially year to date, from below 1% for the 10-year beginning of the year, and they creeped on up to about 1.7%. During the second quarter, though, they came back down, and they're currently at about 1.3%. So that's why you see that mixed performance on the chart above. So those markets did well in the second quarter as those rates came back down. And then lastly, just looking at some U.S. economic data on the left. We'll talk about this in a little bit more detail on the next slide, but inflation at 5.4%, which is I think the highest print we've seen in over a decade there. Next is the GDP growth, 6.5% for the second quarter, so positive GDP growth there as the economy continues to rebound. And then lastly, the unemployment rate at 5.9%, so continuing to kind of trend down from the pandemic high of around 16%. Quick update through last week. So this was looking at the end of second quarter. So what's happened since then through the end of last week? Equity markets, S&P 500 is up another 3.5%. So it's around 19% year to date. Small cap stocks are actually down a little bit. They're down 6%. So their year to date number is around 10%. And then, like I said, the treasury rate is currently at about 1.3%. So still an increase, but not as much as it was. Any questions on anything there? Nope. So the next slide, slide 5, looks at some of the structural forces on inflation. Just wanted to briefly kind of talk about this. It's certainly a hot topic in capital markets these days. On the left-hand side, you can see certain categories that would increase inflation, and then on the right-hand side, certain factors that would be disinflationary. So our view is that in the near term, it is most likely that these inflationary forces do play out, but we do think they will be transitory, and that longer term, the disinflationary forces that you see on the right will overcome the short-term inflationary forces on the left. What's driving the higher inflation that we see right now? It's mainly the top two, tight capacity in some of these sectors. I'm sure you're aware that the chip shortage facing the car market, and used cars are, I think they were up 23% year over year on average. So that's driving a lot of that, as well as just the general, supply chain issues that we're facing, causing some inflationary forces there. Policy stimulus can't be overlooked. The administration has spent lots of money so far this year, and there's more kind of infrastructure bills in the works now. So the increased level of spending there is certainly an inflationary force. On the right side, got two main factors that will be disinflationary long term. In my opinion, the technology is probably the largest one. We continue to see technological innovations that increase productivity, so that drives down prices as efficiencies are increased. And then overall demographics, populations around the globe are aging, therefore, they require more income and tend to spend a little bit more money in retirement. So, kind of disinflationary force there. Happy to answer any questions on any of this, but just wanted to spend a little bit of additional time, given that's a hot topic.
I got one.
Harvey. Harvey's got a question here.
If the next stimulus package goes through, how will it affect that graft?
It's hard to tell for sure, but that definitely falls underneath the policy stimulus section of the inflationary forces. So I haven't been following it too much, but I believe it's $3.5 trillion. I would expect that could move the needle, the inflation needle, a little bit higher in the short term, just given the increase in liquidity in the market and the money supply increasing as well. So all else equal, probably moving that inflation needle a little bit higher.
The deployment of the next level of stimulus isn't as much of a sugar high as the first two. So I don't know that you can draw a nexus to what happened with the first to what's going to happen with infrastructure and hard infrastructure, soft infrastructure, because those have a deployment over many fiscal years versus here's $1 trillion, spend it how you want. So,
Right.
Which is really different, and it's not direct consumer stimulus either. So,
Right.
I think it'll prolong the inflation. I don't know that it's going to create yet another kind of ratchet up to another plateau because of the difference in the way it's being, in theory, going to be deployed. All right. It isn't money until it's passed anyway, so.
Right. Yeah, that's fair to say. And, looking at infrastructure, if that creates jobs, and then those, those jobs, those people spend that money over time, they don't spend it all, obviously right away. So it wouldn't be as much of a shock per se, as to your point of here's direct payments. So I think that's fair to say. So, just moving on to plan performance on slide 6. So, showing performance here through the end of June as well. Overall, pretty strong performance year to date. For the quarter, slightly underneath, you see that 3-month 4.7 versus 5.6. So slightly underneath for the most recent quarter. Primarily due to underperformance in the small cap segment. But at the total plan level, still really strong performance for the longer dated periods. Year to date, up over 12%. Fiscal year to date, which were 9 out of 12 months there, up 23%. Double-digit returns for all the other longer term periods here. 1 year, 30%. Even 10 years up 10.2%. So continue to see really strong absolute performance at the total plan level. Looking at each of the individual managers, starting with LSV large cap, they pretty much matched the benchmark for the quarter, 5% versus 5.2. Their longer term performance, especially over the last year, has been really strong as value has overall outperformed growth. So you can see that their 1 year number, they are up 53% versus the index of 43%. Sustainable growth advisors, we just heard from Steve, so I won't spend a lot of time on them, but positive performance thus far, but they haven't been in the portfolio that long. And then moving down to the small segment.
Cole, how long have they been in the portfolio?
since September of 2019. So they don't have a 3-year. But they have performed, since inception, 31.5% versus 34.9%. So overall, pretty good performance. And actually, through the numbers they showed were through July, not June. It was a little bit better through July. They had a good July. So good performance from them so far. LSV and Disciplined Growth Investors, small cap, both had kind of softer quarters, 3.5% for LSV versus 4.6%, and Disciplined Growth, negative performance minus 0.8 versus 3.9. So that was what kind of hurt the overall total plan. But you look out further, fiscal year to date, LSV up almost 70%, DGI up 47%. Really, really strong returns the further out that you go there. So the plan certainly benefited from that. The appreciation of a lot of those smaller cap stock names over the last year. And rounding out the equity segment, NOR International Equity Fund, performing in line for the quarter, slightly underneath for the year to date and the fiscal year to date. You can see about 18% versus about 28%. So for fiscal year to date, so a little bit underneath there. Their quality style has kind of hurt them in the international segment a little bit, but their longer term performance is still really strong. 3 years, 10.5 versus 9.5. So no concerns there. The next slide looks at the income segment of the portfolio. So you can see here that's composed of the alternative credit managers and the real estate managers. In the alternative credit segment, positive performance overall, about 2% for the quarter versus the index of 1.4. For the 1 year, this segment is up 11.8 versus 4.9. So we're adding value there. You see Wellington performing well across all these periods under review. They were just liquidated at the end of June, so the next time that we meet here in September, Wellington will not be part of the alternative credit segment anymore. So Ares, high yield, also performing really well across all these segments. One Sharp, Max, really good performance from them as well. Always like to look at that 1 year number for One Sharp. You see it's about 6% right now. There's a 1 month lag there, so it'll be a little bit over 6%, which is exactly what they're designed to do. Earn kind of 6 to 7% with very little volatility. So it's always a good addition to the portfolio. Max up 22.3% trailing 1 year. So they rebounded really well from the COVID volatility. And lastly, in this segment, the Fallen Angel strategy that you see at the bottom, that was added here pretty recently, February of this year. That strategy is off to a good start, 3.6% for the quarter versus 2.7%. So good to see that strategy off to a good start there.
Which one, Cole, which one did you say was falling off the alternative credit next month?
The very top one there, Wellington Secured Opportunities. Ideally, those assets will go to fund GI and Pretium,
Okay.
but given Mr. Klausner's comments, we'll hopefully work through any kind of contracting issues there. And lastly, looking at the real estate segment, Principal and Harrison Street performing pretty well for the little bit underneath for the quarter, 3.7 and 3.0. Year to date, they are kind of just right around the benchmark, 6.2, 4.5. street. So they continue to complement each other well and offer good diversification. This is an important piece of the portfolio. If we do see kind of runaway inflation, we would expect that the real estate segment should hold up pretty well, given the pricing power and the contractual obligations that they have. A lot of their tenants shouldn't be impacted by inflation too much. So, all in all, positive news, good performance. Fiscal year-to-date performance really strong. So, we'll see how we close out the next 3 months of the fiscal year. Happy to answer any questions, but that concludes the performance overview.
Staff, have any?
No questions?
I'm not hearing any cold.
Awesome. Well, great to speak with you all. If anything's needed in the meantime, don't hesitate to reach out. And we'll talk to you all in September.
Thank you. Appreciate it.
All right. Have a good one. Bye.
What did we discuss, William, about alternative credits? We were talking about some different options, or what were we, I'm trying to remember exactly. I left my other notebook at the.
You know, I think with respect to the alternative credits, we were just looking at the performance over the past 2 or 3 years since we initiated that part of the portfolio allocation, and just how it's performed in the markets over those periods of time, and whether it's performed the way we thought it would, and whether it's adding value to the portfolio.
But it's like 1/7 of our total fund, right?
Yeah, it's
So it's a chunk.
16%, give or take, right now. You know, to me, it's a longer-term question of, do you think the portfolio and the plan is better off with that as a diversifying asset if it's going to return lower returns over longer
During good
periods
times
versus equities?
So, what I guess what I'm trying to understand, like the philosophy is, so when we do have the bad time or a bad year, you know, we see the 20% down in the regular market, the equity. Is that going to help? Is that going to help maybe save some of the city having to spend more money based on that bad year the next year? You know,
Yeah.
if they're
So they performed, this plan outperformed the general pension plan in the market correction that we had over the past year.
yeah.
But since the
But that was also a small window, right? The
Right.
market correction wasn't
So that's my
15
point.
months of.
You know, if you see a large correction once a decade, is it worth it to give up the returns
The equity all
in
those other
equities
years.
over 10 years to protect the downside in 1 year? Especially when, if you look at like chart, I'll provide a chart next time that our other consultant gives us. It shows the S&P 500 corrections over, you know, the last however many years.
40s, yeah, whatever.
And every time there's a correction, you'll see, you know, the market may be down 20 or 30%, but it comes back within a year to 2 years.
Yeah, you just can't pull it out.
Right. So as long as you're not forced to take money out of the market at the bottom, I'm not that concerned about volatility, and because this is hopefully a perpetual plan. You know, to me,
I guess, yeah, that's what is Dr. Denslow, that's all he said, we should all be in the S&P, right?
yeah.
But, I guess the question is how, if that downtime is a little longer than normal, 2-3 years, I guess, who's it gonna affect more? The plan should still be here, we should be okay,
Right.
but I guess the city, because the members are only gonna contribute what their percentage is, the cities would be
Right.
the one that would see the spike, I guess?
You would see
Sponsored.
an increase in contributions, but remember that the actuary smooth returns over a
Yeah,
5-year
it's
period.
not- yeah.
So it doesn't have a one-to-one effect.
Mhm.
And also, because the plan is so well funded now, you're not funding that expensive part of the plan that is unfunded liabilities.
Right.
So you're funding a normal cost, but that expense is a lot lower than when you have, you know, an 80% or 70% funded plan with large unfunded liabilities that you're counting on the investment returns to help fund. So it has less of an impact on this plan now.
And you're paying it at a discount rate, and the unfunded at a fairly
There's
high.
Cole, did Cole sign off?
I don't see them there, they did leave.
But I guess they're, obviously, they believe in the alternative credit a little bit, that's right, that's why they're.
They brought it to us, and, you know, in my opinion, consultants in general, they like to minimize volatility in
Right.
pension plans or whatever they're consulting on.
That'd be their job, right?
Right, and, you know, I understand that, it's just, we've always had sort of a more aggressive attitude here about how we invest our funds, and, you know, I understand the benefits of diversification and non-correlated assets, but the problem is when you diversify away from equities, unless you're putting it into something kind of, you know, more risky like private equity, you're generally diversifying to lower return assets. And by doing that, you're reducing your long-term returns. And I'm just not sure I think it's worth it. But, you know, that's a board decision. You know, there are some actuaries that I speak to, and, you know, the principal at Foster & Foster, you know, I've had discussions with him, and he agrees. He said, you know, if you're not worried about your cash flow in a pension plan, which we don't really worry about too much, there's no reason not to be 100% invested in equities over the long term. You don't see plans doing that because their consultants are telling them not to do that.
Right. Well, on the other side, Harvey, you got?
Well, just with liquidated Wellington, your real estate portfolio is going to be about 15% in plan. And that's a safe number for protecting, unless inflation really goes cuckoo. I don't see bonds do us anything. And the bonds, the alternate credit bonds are expensive.
Yeah.
You know, I think they have something like 65 basis points over all of them.
Outside of history, you know, obviously it would make sense to have it all in there. I guess as a beneficiary of the plan, my only fear would be there's a little longer of the recession or the drop, and it would be an opportunistic time for people to say, hey, you know, the sponsor can come out and say, hey, this is unsustainable now. Everyone needs to move, you know, these new people, the new hires are going to a defined contribution plan. Because they'll have the doomsday numbers to.
So, yeah, certainly, Eugene, that's, you know.
Could happen.
Yeah, closed plans become very expensive plans. So
Yeah.
the value of the defined contribution is, you know, the cost of retirement.
Right.
Period. I mean, the employer does.
I realize it's stupid.
But if you take a look at that division data that they put out, the most expensive plans are closed plans.
Because they have no member contributions.
Yeah, everything has to come from returns. And then they're the ones that just don't fund, like, you know, but that's not a risk that, I mean, that's not something that the trustees control, but Harvey, you were suggesting putting more into, looking more at real estate as opposed to alternative.
Well, you already-
I wasn't sure, I thought that's what I
Yeah,
heard.
you're going to 15% by liquidated Wellington, and once calls and approves the other two funds. It'll be, then you could do, and some of the bonds are doing for it. And being fair, I was on a board in the 90s where the bond managers for several years came in with big smiles on their face because they were outperforming the S&P. So it can go the other way.
Yeah, I mean,
And
you know,
I couldn't find the chart, I have the chart you're referring to, but I think the longest term, which could have been 1988, was like 37 months or something, from the
37.
bottom to the top. So that's your exposure time, and there's a history of that over like 60 years ago. And the shortest is always been like 9 months, the longest has been like 37 months.
and you know, the thing with real estate, I don't, you know, it can be a good investment. in a lot of time periods. The problem with some of the real estate managers we have are the lockups, especially the newer ones. Now, principal, right now it's locked up, but when markets are more liquid, they have daily liquidity that they provide us, and we've taken advantage of that in the past. The problem is, when there's a market correction or there's a bubble or something happens, then they turn that daily liquidity off and they lock you in for a number of years until the real estate markets are a little more active and they can buy and sell properties. I think the alt credit program was something that we were willing to consider just because Willis Towers Watson, you guys weren't on the board, but they had been, prior to the alt credit allocation, they had been recommending to the board an alt beta strategy, which was really sort of a fund of funds that they ran internally at Willis Towers Watson. And it included things like alt credit, reinsurance, some alternative type real estate securities, and things like that. And I think we weren't comfortable with the way it was set up. We weren't really comfortable with what looked like a fund of funds constructed by our consultant that they were selling us, trying to sell us. And so we backed away from that, and that's when we sort of moved into this delegated investment program that we have with Willis Towers Watson now, where they bring us these managers that we might not normally see. And I think we were willing to look at the program and see how it performed over a period of time. And, for what it is, it's done all right. But I always compare the liquidity, the transparency, the governance, and the returns of equity to these other assets. And when I do that, they just don't look as good. But, that's an unusual approach. But I think it's worth having that discussion with Willis Towers Watson.
Could have been a composition.
Not to throw them under the bus, I've had a problem ever since William informed me of how they have 2 tiers of plans. I always thought you had a consultant, he runs it the best people forward no matter what. Not, he brings about this, but if you pay this group, you get a better group, so that never made sense to me.
And I'm not, I just brought the issue up for discussion, and maybe we can have a conversation with Willis Towers Watson about it again. In direct talks that I've had with them, they firmly believe in diversification and away from equities with a part of the portfolio. But I would say that my understanding of Willis Towers Watson is that we're probably one of their very few, if not their only, public pension plan clients. And their main focus is on corporate plans. And corporate plans operate differently. They have different rates of return, assumed rates of return. They have to assume a risk-free rate of return on their portfolios, and they tend to invest differently than public plans do. And also, I think the potential for those plans closing is greater than for a public pension plan. So maybe they're not as concerned about a 100-year return as I think we should be.
Yeah. Makes sense. Any questions?
Pension guarantee fund is littered with plans that are going to be there forever right now, so.
When my claim to fame, I was on Cooper City, now it's a closed plan.
So,
When they merged with BSO? Yeah.
And your thoughts and input from what you've seen down south or where you came from?
Well, I've seen some of the things down there that he's seen. But I pretty much had the same opinion as William as far as the alternative stuff. You see the numbers, they're low. Yes, they might outperform their benchmark, but their benchmark's low too. And right now, rates are as low as they can be, so, and if they go lower, fixed income's not really going to provide much return right now. Is it a diversifier? Yeah, but I think you diversified well enough with like real estate or even just a couple of bond funds that are less buy and sell, more long-term. That the alternative stuff to me, and it's supposed to diversify away risk on the lower side, but I think if you looked at the year returns that they sent, I think Willis Towers Watson sent, they can drop big. I mean, there's nothing really that says this will always return 0 or above, right? So, and you see we don't get that upper side either. So you're kind of trying to lock yourself in from 0 to 5, but you could get below 0. You usually don't get above 5.
Yeah, we heard the same story in the 2000s about hedge funds, right? It was a really good story. They brought us these guys who were really smart, and the idea was to, buy into these hedge fund of funds and allow these managers to invest in all these sort of esoteric types of things and give you a very stable, low volatility, 8% a year return. And our experience was that they didn't give the return. We were paying enormous fees for this, and 2 or 3 of the 4 funds that we had blew up for different reasons. They were very unstable. We had one fund that had to close shop because 50% of their assets were from one client, which we didn't know, and when that client stopped investing in hedge funds, it put the fund down. And then a couple of our other funds, although we weren't told this, they had feeder fund investments in the Madoff funds. And so it didn't hurt us that much when the Madoff fund sort of imploded. It caused those funds to be down 1 or 2 or 3% for a given period. But it impacted their clients because no one wanted to be in them any longer. So clients start leaving a fund, asked to close. And that's what happened with several of the funds we have been in.
Is Austin Capital still around?
I think they probably still are, but they're a much smaller firm now.
Yeah.
So, my point is you're paying high fees for, returns that, if we could annualize at 11.8%, that would be great. I would accept that, but I'm not sure, I don't know that I believe we're going to do that because the 3-year number is 4.5%, right? To me, it's hard to accept a 4.5% return. I'm not saying that's what it's always going to be, but 4.5% in an alt credit strategy over time versus, 9 or 10% in equities over time. You're getting half the return, and it just, it seems like a high price to pay for some non-correlation assets, which actually, when markets have big corrections, sometimes go closer to 1 than to 0,
Yep.
So my point is it's worth having the discussion at some point, maybe with whether we, with Willis Towers Watson, whether we think the alt credit strategy is really benefiting the plan, and how I just would like to continue to push them on how they justify it.
Yeah, it just seems to me allocating a policy benchmark of up to 17.5% into at least a strategy that we have no expectation of it ever really to over the long term. I think this is where Harvey was going, to hit the plan benchmark, our assumed internal rate. That's with 58 million plus dollars, 59 million for all practical purposes, that is sitting there in what is a fixed income, I don't know. It does seem like you have a longer there's a better chance of opportunity lost than opportunity gained.
And
with that strategy.
in the event of a recession or a down market a year, no one expects any of these to
Save the plan.
like make 30%, right? I mean, real estate maybe go up, but like,
There
what's,
wasn't a benchmark.
We're gonna hit a wall in a
for
year on that real
credit
estate.
3 months ago. Maybe so, there was no fair comparison.
But even going into it, you have a more of a in theory, fixed income return expectation, because that's what it is sitting there as.
Yeah, in the 2000s, in the 90s and the 2000s in particular, you know, you saw double-digit returns in real estate. These days, no one expects that. You know, you're expecting, you know, 7 or 8 or 9% maybe.
Well, that's at least,
That's better than a bond.
well, and it's also at least more in line with the
Assumed rate of
assumed
return.
rate of return.
Right.
I mean, I mean, I understand diversification, but, and I'll tell you what, I would never overreact to a single down year. That's gonna happen. The market cycle is the market cycle. This is a perpetual investor. It seems like a lot of money sitting there with very little upside.
Well, you know, maybe for the next meeting, you know, we can ask Willis Towers Watson to be prepared to review it, review how it's performed over the past 3 years, and how they think it's going to perform going forward compared to equities, and, you know, how they think it benefits the plan. Because to me, diversification to a lower return asset, you know, that doesn't benefit the plan.
would they be able to get us numbers for a few more years than that? Theoretically, they should be able to, right?
They can provide, you know,
Even
for
though we
all
did-
of those managers, they can give you numbers, but, you know, it's, with the caveat that it's not our plan, it's their general return for that portfolio.
Right.
Right.
It'd be like a
And
manager
it's,
search.
and it's their projection, obviously.
Well, like I said, we wouldn't get our numbers from what our money did in there, but what that plan had, or what that fund or that money manager
Yeah.
produced, right?
They can provide that, I'll ask them to provide that.
I'm just curious, a little over 3 years, you know, because we had some,
Well, and some of those managers and some of these funds haven't been around that long, like they probably don't have 10-year numbers,
they don't yet.
but they might have
Have
5 or 7-year numbers, and we can get those.
We asked to have the chart added of the up-down years in months like ANCO had. I couldn't, I have it here somewhere.
You mean for like the S&P 500 or?
Yeah, this, you know, the down years and the up years and the time lapse between the
Sure.
peaks and troughs.
Yeah, if nothing, I mean, I'll ask Willis Towers Watson for that, and even if they don't have something like that readily available, I can share what ANCO presented to
I
us.
have it here somewhere, I just couldn't find it in a hurry.
All right. Sounds like fun. What else we got? That was Willis Towers.
Presentation that we put together for the city commission.
Oh, so working on a presentation for the city.
Let me share this screen if I can.
Well, great.
So,
Couldn't we get a newer police vehicle than that?
Yeah, instead you get the nice red truck and you
I
can.
know, man, you get a high end of the fire.
You guys got newer than that?
Yeah, we got the Ford Explorer.
The Explorer.
Oh, that's
We're not
right.
even buying the Chargers anymore because they flood.
we'll work on the image.
I'm just teasing.
They don't have to
Wait till the Tesla shows up.
Send me a ticket and I can wiggle it in.
Well, technically, it's
So if the board will recall, the city manager had requested that the city commission had requested all of its boards and committees to give annual presentations to it, you know, last year, at the end of last year, they started making that request. And although this board is not a city commission board, it's a statutory board, the city manager requested that this board also make a presentation. And Bob Klausner had agreed that a lot of his plans do that. He sent us some information, and we sort of combined that with a template that the city commission or the clerk of the commission's office had created for us, and we came up with this presentation. Basically, to just walk through the slides, we showed who the Board of Trustees is, how long you've served. We also took some data from the actuarial vals just to give them an idea of what the plan membership looks like for both police and fire. And then we showed the contributions for fiscal year 20. The state contributions here, we use this number because that's the base year amount that actually stays in the plan. Anything over that amount goes into the share plan. So for all intents and purposes, that is the state contribution. And then we just showed a brief return summary of the plan versus the benchmark for the year-to-date, 1, 5, and 10-year returns. We also, because the commission, I think the idea behind the request for the presentations was for boards and committees to give an update on what they had accomplished the prior year. And, really, I think the main focus of this board is investments, so we included that, but we also mentioned that the pension bond proceeds have been received and invested. And this just shows, we thought it might be nice to show the asset class allocation for as of June 30, 2021. So we showed that with a nice chart. And then, part of what the commission asked for was if the board, if there were any recommendations that they needed to make to the board, or if there's anything that the board would request of the city commission as well. So this is just the final thank you slide. But if the board has any requests for edits or additions to this, we can do that.
Go back to, I'm sorry, I should ask to be recognized first.
Yeah, and I've got my hand up when you're done, Steve.
Oh, I'm sorry, there's a glare right there, Walt, I'm sorry.
Go back to where you did the POV, showed the time that it was invested over November through January.
Right.
And this may not be for the presentation. I'm curious to see the arbitrage between the interest and the interest paid on it versus the return on those assets.
So,
And I don't know, I don't want to,
no,
it's more out of curiosity. I'm sure that, to me, that is the benchmark, whether the POV added value to the plan sponsor.
Right. Is there enough time to look at?
Yeah, I know. And not for this, I'm just curious.
Yeah.
It's not a, our job is to maximize the return based on our risk parameters, period. And I think that slide shows that this board does historically a good job at that.
right. We have prepared a detailed return analysis for the pension bond proceeds for the general pension plan, and it requires a little bit of information from the consultant because it includes partial month returns for the managers based on when they actually received the allocation. I've asked Willis Towers Watson to provide those same numbers. And so we have a nice table that shows the two tranche. We'll have a table that shows the tranche timelines for each manager in the returns year to date. We'll also have a few graphs in there. And then the city manager has requested that once we get that information for the police and fire plan, we already have it for the general, that we take that back to PFM, which was the financial advisor on the bond issue, and have them do that arbitrage calculation through June 30 of 2021 to show, because they made certain assumptions about what the plan would return, and showing.
Yeah, right.
And so we've returned, actually, on the general pension, we returned 16% year-to-date on the bond proceeds themselves.
Yeah.
And, the assumption was that for that time period, we probably would have earned the assumed rate of return or that partial rate of return, and it would have been about 5.5%.
Yeah. And the relative net present value of success of a pension obligation bond is really generated in the first 12 months in the market. If you put it in and lose, it is hard to make up over the bond term. So
I hope that
we're not a timer, but every once in a while, we do get money, we put the money in when you want to. I think the first pension obligation bond had the same nice return years almost immediately after injecting the
We
funds.
were more confident in the markets in 2003 than we were this time, but we had a nice surprise. You know, I'm not sure anyone expected the markets to perform the way they have, but we'll certainly take it.
Right.
Okay.
So Steve, is that,
William, I have a question when you get a minute.
yeah, well,
Go ahead.
There's a slide that referenced an age, a salary of members, and I presume that was active members, but I'm not absolutely sure. I was thinking it might be helpful to have a median in there as well as an average. Oh, there it is, thank you.
average salary.
I presume there's a corollary for police as well, but the average salary is 65,000. Is there a number that we could add in there, the median as well?
We'll take a look at the VAL. Those numbers come straight from the VAL, and so we kind of, we rely on the actual evaluation report to pull those numbers out. We'll see if they have a medium salary in there, and if they do, we'll add it.
Yeah.
Thank you. Yeah, and when do you expect this to be presented to the commission?
Well, it's up to the board to approve it, and then, to determine whether you or Steve are gonna be the one to give it, or who they would
Right.
like to give it, and then we will look at the city commission calendar and see how quickly we can have it added as an agenda
That's
item.
fine. Yeah, that's fine. Good, well, I'll make a motion that be approved by the board and forwarded to the manager.
Well, the median is traditionally about $2,000 less than the average, because
That's what
it's
my,
gonna have
that was
less-
my thought as well, Steve.
it'll
Right.
have less volatility now because of the outliers and with the overtime cap on
Mhm.
pensionable earnings. So,
Yeah.
so you're not gonna see as much of a spread between average and median as you did
Oh, I see, okay.
10
all
years
right.
ago because of the lack of ability for a few outliers to drive that, the Benny Smiths of the world.
Gotcha. All right, that's what I was thinking. So if it's not that big a deal, don't worry about it. It's just, I knew the question will come up, and I wanted to have some kind of a response.
I'm a big believer in the median over the average too, Walt, so.
I know.
We'll see what we can find, and if we can find a median, we'll put it in there. It doesn't hurt to add a line.
Yeah. Either way, it's an excellent report. I thought you guys did a nice job on it.
All right, well, there's been a motion
I'll second it.
there's been a motion to accept the presentation and to present it to the board, or I'm sorry, to the city commission. It has been seconded. Is there any more discussion? Does anyone think anything else needs to be added?
Nice job, you two.
As soon as I guess it makes the schedule, let us know. Most of us will
We
try to
may
go.
try to get it on for a September 16th city commission meeting. We have another item that we hope to go to that meeting, an investment policy for a different plan for our retiree health fund. And
Right.
since the city commission is already hopefully going to be meeting as that board for a few minutes, they could maybe also meet as, well, actually, this just goes to the commission. They don't have to meet as the board. I'm sorry. So we'll shoot for the 16th. We'll shoot for getting it on the 16th. But we'll
That worked.
let everyone know.
How many people are they letting in the room
Excellent,
now?
thank you.
We still have to vote on it. Seeing, hearing no further discussion, all in favor, say aye.
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 Any opposed? Okay, the motion passes.
They only have about a dozen chairs
A
in
dozen?
the auditorium,
Yeah.
but the last meeting I was in, there were a lot of people trying to stand around the room, and so it's kind of still,
They stand outside and then we'll let
Okay.
them in as
Yeah.
people.
I was just, depending on what else is going on, I didn't even know if 3 of us would be allowed in there, I don't
We
know.
come to 5 minutes before the regular meeting.
You can get an entire,
They're
one of the-
they're sitting as a board.
they have to be
They gotta
outside.
sitting, like, rotate them in and out.
Once you speak, even then, they go up
They're
there and they'll
only-
sit
this
there
is
saying
information.
notes.
Been there for 4 hours.
you know, the other option is,
We can ask for it to at least be a time certain since,
Yeah.
you know,
And
every
the other option
members of
is-
the board have jobs. Except for Walt, aren't you retired now, Walt?
Say it again?
I said, are you retired now, Walt?
Yes, I am. I know you can't tell the difference from when I was working.
No,
but yes, I am.
that's not what I meant.
We can also look at trying to schedule it for a general policy meeting. I believe they have heard some of these presentations, board and committee presentations at their general policy committee meeting.
Yeah.
And there are typically fewer people there and a smaller agenda.
William, the only advantage I think to presenting it to the full board and having it go in front of all the public is for the public's information. We've had a lot of disinformation, but not a lot. We've had some disinformation expressed to the city commission about the police department pension fund, and I think it's helpful to nip it in the bud, as they say.
Okay, well, we can definitely put it on a city
Well,
commission agenda.
that would be their call, obviously, but nevertheless, or your call for that matter, but that was my thought.
Yeah, the motion was just to present it, we didn't say how.
Yeah,
However
exactly.
however you
Yeah,
all like
right.
it.
Mhm.
All right, next on the agenda, we have electing a vice chairperson.
Well, I'm going to nominate, you're the chair, I'm going to nominate the other public safety appointed member. I just think it makes sense.
I'll second that.
That would be Bruce Giles. Yeah, you didn't know I just was doing it.
I thought we elected you long ago to be the vice chair.
I'm secretary.
I thought that was
So if you recall,
You actually said that our rule doesn't, actually, we don't have a vice chair.
right, we never had one because the state statutes only require that the boards elect a chairperson and a secretary. But Steve had brought the issue up a few meetons ago, and we asked Bob about it, and he said that the board could certainly elect a vice chair, and that plenty of boards have them. And so it's nice to have a vice chair in case the chair is not here, then the vice chair can take over the meeting.
Right.
So it's up to the board, you can do whatever you like.
Well, I thought I heard a motion that it would be the other public safety member. Without being specific, because
I said, I actually said Lieutenant Giles.
Bruce is gonna retire, and, well, you're gonna be around them for a while, so, anyway.
Through the end of his term, he'll be around, so
Yeah, exactly.
at least we hope.
So did you mean to nominate Bruce, Steve?
Yes, I did.
I'll second that nomination.
Okay, under discussion. There's a motion, it's been seconded. To clarify the motion is to nominate the other elected public safety as the vice chair, right? Is that
That or Harvey. I'm following
Well,
either one of those. I just don't, I'm fine with either a just to let you know, I'm fine with a member selected or a
member slip?
Right.
trustee selected. Appointed by the commission doesn't, you know.
Did this come up when I wasn't here?
Yeah.
Originally, is that what it was?
We were all, I threw the gavel at
Eugene's
Bruce,
not gonna
he
keep
threw it
showing
back
up.
at
Yeah, the hot
me.
potato, nobody take it.
So just, I think.
No, but it does bring, because I know, although I haven't been recently, I know there's several things that I'll have to show up and sign to send back to the state, and if I'm not around, or, so I guess, obviously, I'm sure any other trustees could assign it, and the state would be okay, but I don't know what.
Some things they want the chairperson specifically to sign.
Right.
But those are few and far between.
Mm-hmm. Well, I'm good with it, Bruce.
Right.
All right. So we'll bring it to a vote. All in favor, say aye.
Aye.
Any
Aye.
opposed? The motion passes. All
The
right.
nice thing is, when you go to the FPPTA conferences, your name tag should say vice chair now.
See, there you go.
If we ever get to go. You know what? I gotta go to one.
There's one coming up, I'm already signed up.
And you get access to the helicopter
There's
too.
one in October if board members would like to go. I'm not sure that I think it's in person in Jacksonville at Sawgrass. I can send the information out. I'm a little, I wonder if they will continue to have it if we continue to see the COVID spikes.
Yeah, I doubt it.
But it's on right now, so.
Right.
Yeah, can you send me
It'll
the,
work out really good if it does virtual again.
Their website always has all the stuff right on there too. Well, usually I say.
I don't want to, along with what Steve was saying, I was curious as to what the hard dollars spent on the pension obligation bond as compared to how the city contribution changed, whether or not it was, I don't know if that figure's out there, but
Yeah, it removed the entire UAL payment, so now it's just the UAL less the net savings of the city, the UAL portion, which was actually the larger portion of the contribution rate for the city, less the debt service charge. But it's generated, gosh, I've heard so many different numbers across both of them. I mean, Cynthia's here. What's our official position of the value of the POV to savings to the general fund?
Sorry, I was trying to unmute myself. We were estimating $4.2 million savings in total, but you know, those savings have been taken up by other expenses since then.
We can only save money.
Much to
we don't
Brian
decide how to
O'Brien's
spend.
chagrin. And we can bring the original POV presentation material, which shows based on the assumed rate of return what the savings would be over time. So I can bring that at the next meeting, and then if we can get the information from Willis Towers Watson in time for PFM to update those numbers, we can bring that as well. But we'll have it for you in September.
more a curiosity thing with me.
All right. Informational items.
We'd already kind of seen that, you know, that's just the approval letter from the state.
I have a question about the 185. Just because I don't have the answers and people have asked me. When we first got into this, I don't know, maybe 5 or 7 years ago, whenever we finally changed some of the system, everyone had an opportunity that one-time opportunity to pull it out, put it in their own investment program. But the belief was that the city was actually investing the money also, and that most kept the money in, assuming the city would get a bigger return than if they invested it in their own ICMA. Is there a return on the 185 money that stays, that people?
Yeah, whoever stays, doesn't move their share plan to ICMA, they earn what the pension plan earns.
Yeah. Okay.
That was the bargain rate, right, Steve?
And it's like the fire, they do it annually, so like if the year.
There's a
if
1 year
the plan
lag.
gets it 1 year, it's,
Yeah.
if the plan made 10%, then that chunk of money for that year gets 10%. It's not following the market the whole time. Like, so the next year, that certain amount of money gets the percentage. that
Yeah, we
you
make
got.
an interest transfer every year.
Every
The
year,
county makes
one
an
time.
interest transfer from the pension plan assets to the share plan assets.
So if the plan's down 30% the year you retire, you're not gonna lose that whole 30. Your annual amounts all got the interest that they would have earned that year. And that amount's still sitting in the account for you, is that correct?
Yeah,
The excess amount.
yeah.
Okay. Is there anything you can give me on what interest it has grown each year, so they understand?
Yeah, I mean, I can, so it's different for each, it's based on the balance that the person has in their account, but I can show you the historical returns of the plan, and, you know, you can see that is what was applied to that person's account the year after it was earned.
And even if you look at William and them do a value of the plan at higher before date type, remember that's kind of how,
Yeah.
that's our references to what.
If you were hired in a certain year,
Yeah.
this is what your balance
So
is.
if you'll just see the difference from year to year, it's not just the allocation of the share per person. There's allocation plus interest on those
Right.
things, is what it really is, the movement of the value of that from year to year.
Okay.
Except now that police only has about 15 guys who are eligible, then their share amounts far outweigh their,
No,
Right, I know, but
I'm 35 because I wish it was a little lower.
all right, 35.
All right.
You
So we've
know,
already got the reports been accepted.
so, yes, it's fewer, but I will tell you, the manner in which they define membership is more consistent with what a supplemental retirement.
Yeah, I would have argued it should have been that from the beginning,
So,
but
Well,
when we
yeah.
bargained it,
Not, barring, we don't, stock market doesn't crash next month, the firefighters may be getting with the city about bargaining, maybe at least that someone's vested.
Yeah.
You know, when we have this turnover, these guys come 1 year, 2 years, and like I said, you know, the next year William takes their share and redistributes it.
Yeah.
And
Yeah.
I don't know if it would be easier if we only, you know, counted vested.
Yeah, it would. It would, the fewer number that I have to calculate, the easier it is.
So, and this is the thing that I can only tell you, as I was in the original bargaining with the FOP PBA, that I did a poor job of trying, I think explaining. It was about, oh, I need the votes. The only people this is going to add value to is folks who retire from your pension plan. People who put a career in. That was the intent of the supplemental retirement requirement in the statute. And I even showed them the math that, you know, smaller numerator, better for you, smaller denominator. So, so I did a poor job, and we had a lot of folks who, and you think you have turnover? Ask Lieutenant Giles about the people who are turning.
I know theirs is worse than the other one.
And that is administratively a lot of work. Calculating the forfeitures and then reallocating among the plan members.
Right.
So it's not just a bigger allocation. It's being directed to folks who will actually retire from the plan.
I think I like how the fire did it though initially, because at least some of that, our money, we didn't have the share plan, so it was sitting in there. And technically some of those shares were to retirees that have been gone, so we really needed to get that money dispersed. And now going forward, maybe make it a little more, you know.
The police plan was structured the same way. If you earned if you earned a share in a year, even if you had left, they had an initial allocation. If you look at the ordinance, it has initial allocation, it has annual allocation language. But you could have done that even with the smaller, with the redefining it.
Yeah, the initial, we still could have done it, yeah. Just
it would have no impact on them probably. Oh, maybe, yeah, because.
Well, there would have been someone that had been here 9 years and
they're gone.
said, well, I don't.
At least squeeze the juice out of that lemon. Let's move on.
Exactly.
All
right.
Anyway, is it something we have to do an impact study for, because it doesn't really affect the plan per se?
No, the only thing that affects the payment is you remove the base amount, so.
Any public comment? No members are present? The next meeting date is Wednesday, September 22nd, 9 a.m. in this room. There's no other comments? Questions? All right, motion to adjourn is in order.
Second.
All right. There's a motion to adjourn. Walt, you have anything to say?
I'm cool with that.
All right.
I saw that September 22nd, I'll be in that room.
All right. All in favor, say aye.
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 Any opposed? All right, the motion passes. Thank you. Meeting adjourned.